Imagine two people. Person A earns $100,000 a year. Person B is worth $100 million. Now imagine person A opens their paycheck and says, "Wow, taxes." Then person B opens their tax return and says, "Wow, barely any taxes." And that's the moment most people start wondering if the IRS is running a completely different game for rich people. The short answer? Kind of. The longer answer: the rich aren't usually hiding money in secret volcano layers. They're often using legal strategies that exist right out in the open. Strategies that lawmakers created, strategies that accountants adore, and strategies that make regular taxpayers stare at their W-2 forms, like they're participating in a financial Hunger Games. So let's talk about some of the tax tricks rich people use. Legally, like very legally, so legally that entire skyscrapers full of lawyers help them do it. First, let's talk about the biggest difference between regular people and wealthy people. Income, or more specifically, not having income. That sounds ridiculous, but stick with me. Most Americans make money from work. You go to work, you get paid. The IRS immediately appears like a magician. Now you have less money, simple but wealthy. People often make money differently. Instead of earning income from a job, they own assets, stocks, businesses, real estate, investments, and here's the key. Assets can grow in value without creating taxable income. Imagine a stick figure buys a stock for $1 million. A few years later, it's worth $10 million. The stick figure is now $9 million richer. But has he paid tax on that gain? Not yet, because he hasn't sold it. This is one of the biggest advantages in the tax code. A gain isn't usually taxed until it's realized. Translation: the government generally doesn't tax your stock market winnings until you actually cash out, so the rich can get richer on paper for years, sometimes decades, without triggering taxes. Already, we're playing a different game. Now comes one of the most famous strategies. By borrow.die.yes.that is literally what people call it. It sounds less like tax planning and more like the title of an action movie starring a billionaire accountant. Here's how it works. Step 1. Buy assets.stocks.businesses.real estate. Whatever step 2, let those assets grow. Step 3. Instead of selling them and paying taxes, borrow against them. Imagine you own $100 million in stock. You need $5 million to fund your lifestyle. You could sell stock, but then taxes show up, or you could use the stock as collateral and take out a loan. Loans are generally not taxable income. The bank gives you money, you keep your assets. You avoid triggering capital gains taxes. Everybody smiles. Well, not everybody. Then comes step 4. Die.not. Immediately, there's no rush. Take your time. The point is that in many cases, heirs may receive assets with a tax basis adjustment, often called a step-up in basis, which means a lot of the unrealized gains may never face the same capital gains taxes that would have applied if the assets had been sold during life. And suddenly a tax strategy sounds suspiciously like a life strategy. Again, this isn't a loophole hidden in a secret cave. This is a well-known feature of the system. Now let's talk about real estate. Because if taxes were a video game, real estate would definitely be one of the premium expansion packs. Rich investors love real estate, and for good reason. One magical word: depreciation. Depreciation says that buildings wear out over time, which is reasonable. Buildings age, roofs get old, paint fades things. Break the tax code lets owners deduct part of that decline in value every year. Sounds normal until you realize something strange. A property can sometimes increase in market value. While still generating depreciation deductions, imagine a building worth $5 million. A few years later, it's worth $8 million. The owner got richer, yet may still be claiming depreciation deductions. It's like gaining weight while claiming calories disappeared. Real estate has always been a bit special. Then there are 1031 exchanges, a name so exciting it sounds like a Wi-Fi password. A 1031 exchange allows certain real estate investors to sell one investment property and buy another while deferring capital gains taxes. Notice the word defer, not eliminate. Defer. The government basically says, fine, we'll discuss this later. And later can sometimes become very, very later. Now, let's discuss businesses. Because rich people love businesses. Businesses can deduct expenses. Lots of expenses. A regular employee drives to work. Too bad, a business owner drives to meet clients. Potential deduction, a regular employee buys equipment. That's unfortunate. A business buys equipment. Potential deduction, again, there are rules. Lots of rules, very specific rules, but businesses often have access to deductions that ordinary wage earners simply don't. This is one reason wealthy individuals frequently structure activities through companies, partnerships, and other entities. It creates flexibility, and flexibility is often another word for tax planning. Now, let's talk about capital gains, because the tax code has always treated different types of income differently. If you earn money from working, that's ordinary income. If you earn money from investments held long enough, that's often taxed at lower long-term capital gains rates. So two people can receive the same amount of money, but depending on where that money came from, the tax bill can look very different. This is where many debates about fairness begin. Some people argue investment should be rewarded. Others argue work shouldn't be taxed more heavily than wealth. Congratulations, you have just entered a political argument that has been running for decades. We will now slowly back away. Another favorite strategy, charitable giving. Now, before anyone gets angry, many wealthy people genuinely donate enormous amounts to worthwhile causes, hospitals, universities, research, foundations, charities. These donations can also create tax benefits, which leads to one of the greatest misunderstandings in personal finance. Some people think rich people donate money and somehow make a profit. That's generally not how it works. Giving away $1 to save 40 cents in taxes still means you're out 60 cents. But tax deductions can make charitable giving less expensive than it otherwise would be. So philanthropy and tax planning often end up working together. Then there are trusts. Trusts are where conversations start sounding like Victorian-era legal fiction. The assets shall be transferred unto the irrevocable trust. Nobody knows what's happening anymore, not even the stick figures. The basic idea is that trusts can help manage wealth, control inheritance, protect assets, and sometimes reduce taxes under certain circumstances. They're not magic, they're just complicated. Extremely complicated. The kind of complicated that generates entire careers. Which brings us to the most important tax trick of all. The richest people don't just buy assets, they buy expertise. Accountants, tax attorneys, financial advisors, estate planners, teams of professionals whose entire job is understanding rules that would make most people's eyes glaze over instantly. That's a huge advantage, because tax law isn't just about money, it's about knowledge. A billionaire and a middle-class worker might technically be operating under the same tax code, but one of them has a team reading all 70,000 pages. The other is clicking through tax software while eating leftover pizza, not exactly the same experience. Now here's the important part. Most of these strategies are illegal because lawmakers intentionally created them. The government wants investment. The government wants business formation. The government wants real estate development. The government wants charitable giving. So the tax code provides incentives. Whether those incentives are fair is a separate question, but they're usually not accidents. They're features, not bugs. So when people ask, how do rich people pay less tax? The answer is often surprisingly boring. They own assets instead of earning wages. They defer taxes. They use deductions. They use structures created by the law. And most importantly, they hire people who understand every inch of the system. The tax code is a giant rulebook. Most people skim it. The wealthy hire experts to study it professionally. And in a game where the rules matter, that makes a huge difference. Because at the end of the day, the biggest tax trick isn't some secret offshore island. It's understanding the rules better than everyone else, which may not be the most exciting answer, but it is probably the most accurate one. And somewhere right now, an accountant just smiled, which is honestly the most terrifying part of this entire story.